our interview series where we bring you some valuable insights from top fund managers across leading AMCs. Now, today, joining me and my colleague Chirag is Daylynn Pinto, Senior Fund Manager Equities at Bandhan AMC. Welcome, Daylynn.
Hi, thank you. Thank you for having me on the show again.
Good to have you with us. Now, Indian markets have been volatile for quite some time now. What do you think? The volatility is going to be persistent or it's going to ease out in the near term?
No, I think, volatility is something that we all have to get accustomed to. This is a common question that keeps coming every 3 to 6 months, whenever I'm talking to someone or the other. I think in general, we are in a very volatile world, be it geopolitics, be it tariff wars, be it, what's happening within the country, outside the country, etc. So I think volatility is here to stay. I think the key would be, how you keep a rational, composed thought process during these volatile times, and how you construct your portfolio to navigate, through these times. Uh, so, so long answer short, this is something we need to get used to, something we need to learn and try and figure out how to navigate. And hopefully, there will be light at the end of the tunnel.
Dylan, what key factors or catalyst could trigger a recovery in the Indian markets over the coming months?
So I think, there have been a couple of issues over the last 6 months. Indian markets have been a little more turbulent than we would like them to be. I think part of it is global and part of it is local as well. I think on the global side, post the US election, obviously the uncertainty has moved up a notch. Given the kind of policy announcements and agenda that we've heard from the US side, that has definitely created some amount of uncertainty. I think across the world as such. Uh, Simultaneously, on the Indian side, we have unfortunately had a slowdown not only in our economy but also in the earnings of most of our companies. And I think that's the first time that we are seeing something of this nature over the last 3 to 4 years, right? So I think the market, which was fairly euphoric and exuberant maybe 6 months ago, both on the earnings side as well as on the fact that India was and probably is still, on a very strong macro footing. I think to some extent, the recent, policy directions of the US, of what we're seeing, across the world, and this combined with the slowdown in earnings and slowdown in growth that we're witnessing in India, has kind of derailed what was otherwise a very, very secular, bull story for Indian equity markets. Having said that, I think going forward from a recovery perspective, I think two or three things that investors are most concerned about. I think one is some sort of clarity on US policy. I think that is something that we are all very closely, watching out for. The second is, whether the Fed will be in a position to actually go ahead and cut rates this year. We had an inflation print yesterday, and it was not great. And I think, again, questions are kind of being raised as to whether, the Fed will be able to go ahead with more than one or two cuts this calendar year as well, right? And that has, massive implications for emerging market capital flows, and India's, one of those recipients. I think the third aspect is whether the Chinese recovery is real, whether the Chinese recovery will strengthen as we go through this calendar year. That would have implications for asset allocators globally, and especially emerging market asset allocators. Because India, mind you, for the last 3 years was kind of the TINA investment destination for the world in some sense. And with China making a comeback, I think there could be some amount of capital flow that could go there as well. But I think fourth and most important is our GDP growth and our earnings story have to come back on track. And what we believe is that we are going through a typical cyclical slowdown. We had a couple of good years on growth. We are kind of, consolidating, for the last two odd quarters, we probably consolidate a little more, before growth starts to make a comeback. So I think when you look at a combination of all this, we need some of, these things to come into our favor for capital to really come back into India in a very, very large way. And last but not the least, being a value investor, and it will be, I'm sure, some of your questions throughout the show. I think valuations are never talked enough. And Indian valuations need to get, to my mind, a little more attractive for the market to become juicy so that we get not only domestic, but more and more foreign capital back into the country, right? So I think it's a combination of all these.
So, Dylan, you rightly spoke about that, markets has to be little bit more valued. So, despite the correction of what we have seen, like 10-15% correction in the markets, don't you think so it has become slightly attractive, or you are waiting for some more corrections to, get into the market?
So at the headline level, markets have become, I would say, slightly more attractive, especially the Nifty. On a stock by stock basis, there are, I think, quite a few stocks that are actually throwing up interesting opportunities. So a little more bottom up sort of market today, if you ask me, as compared to top down. The Nifty is yet not at its last 10-year average of about 18 odd times 1 year forward. So we are shy, a little slightly higher levels than where that would possibly come out to. So the answer to the question is yes and no. I think there are bottom up opportunities, but do I think the market can correct a little more? I think it could. And not necessarily it has to be a very steep correction. It could also be in the form of some sort of time correction as well. So I think probably a combination of both. But as I mentioned, earlier, I think the real focus will be on whether growth, comes back and that results in earnings upgrades. And that I think is still a quarter or two away at least. So I think the markets will continue to grind lower, maybe consolidate a little more before finding its feet to take the next leap.
Well, now can you share your investment philosophy with us and how has it evolved over the years?
So, to sum it up in one line, I've always said that my philosophy is buy at the right price. So I'm not fixated on a sector. I'm not fixated on a set of stocks. I'm not fixated on somebody's definition of growth or value in some sense. Every asset class, every security, has some sort of intrinsic value which one needs to identify. And if there is value, if the price is right, I'm very happy to take a position in that particular security, right? So for me, that is really paramount. Over the last few years, I think what has really changed in terms of thought process, and I think that's for everyone, is that the markets in general have gradually re-rated over the last 20 years. So Nifty multiple, for example, the 20-year history would be about 16 odd P. The 10-year history would be 18p. The last 5-year history would be 20p. So gradually we've kind of gotten accustomed to multiples moving up in some sense or the other. And what, as a value investor, I think, especially being in India, I think that what's resulted in us trying to not think about absolute value as a reason to buy a particular stock, but more look at relative value and where the margin of safety is higher. So the way we define value for our funds is very simple. One is, of course, you need to identify a set of stocks at the right price. I think that's one. The second is you need to look at relative value across market caps. So is large more attractive than small? Is small more attractive than mid, etc.? The third is we try and look at relative value across sectors. So would it be the right time today to be overweight banking, underweight IT, or vice versa? And the fourth is really the absolute stock picking part, where we kind of use an absolute value framework, where margin of safety is the highest, benchmark that we kind of put each and every stock, test each and every stock against.
Dylan, you spoke about the right price. So could you just help us with what exactly is the right price? Because it changes from the market to market and from time to time. Could you share with us some few examples to get more clarity on it?
So I think you rightly said it changes. It's a very fluid definition, right? I think investing is an art and a science. So it is very easy to pin your decisions on pure quant-based models, which tell you that, oh, at this price to book, or at this EV to sales, or at this EV to EBITDA, I will buy a stock, or I will sell a stock. But I think there are many more factors that need to be fed in, depending on what the environment is, and accordingly, to some extent, there is no singular definition that or a wonder formula that I can give you that helps us arrive at that price. But I think the genesis is very simple. I think our value investment philosophy really hinges on two or three things. One is we start with a contrarian approach, which means that we like to look at things that the market is not willing to look at today. That's typically where the starting point is in terms of trying to find ideas in some sense. The second is we try to figure out whether those sectors of the market or those segments of the market are why are they being overlooked? Is there a risk to terminal value in those companies? Is there a structural derating possible in those companies for some reason or the other? Right, and from that analysis, we try and come up with okay, what is the risk reward that we could potentially have if we were to buy that particular security, or we continue to hold that particular security, because the logic also applies for sell in some sense, right? So I think it's a combination of an iterative process that we keep doing time and again, like I said, both on a relative and an absolute basis, before which we take a decision whether to include or exclude a set of companies from the portfolio in some sense.
Dylan, now coming to specifically one or two fund specific thing, the ELSS Tech Saver Fund has underperformed the benchmark in the last 1 year and in the third quarter for the 3 year period. So, what is the reason for this performance, and how do you plan to improve it going forward?
So I think what we've done over the last year and a half, and this is true of all my funds, is I've tried to reduce my mid and small cap exposure. So I think that is something that we have done very, very actively over the last 18 odd months. If I recall correctly, maybe 18 months ago, mid and small cap exposure would have been as high as 35, 40 odd percent in the fund. Today we are under 25% as far as mid and small exposure is concerned. So I think to that extent, there has been some impact, especially in the last 12, 15 months where post Jan 12 months, I think mid and small have underperformed. But if you take a 15-month period, I think there's still a very, very healthy, or a 2 year period, there's still a very, very healthy outperformance of SMIDs over large caps. The second thing is that we've tried to reduce very, very high beta sectors in the portfolio. And we try to gravitate towards more, secular themes where today's narrative may not be very exciting, but we do believe that over a 2 or 3 year period, capital will rotate into these sectors, right? So slightly contrarian in that aspect. So I think the game is very simple. I think our focus is really on more towards looking at 3 year and 5 year kind of performance buckets. And trying to see that how can we keep rotating capital and change our portfolios every 12 to 18 months so that we keep that 3 and 5 year goal in mind. Because when you think about ELSS, the minimum holding period for investor is 3 years. So unlike most other funds where people can exit in 6 months or a year or two, ELSS money is a little more sticky, a little more long term in that sense, and that helps me take slightly longer term calls, in that sense.
And if you look, even if for the Bandhan Sterling Value Fund has slipped in the 3 year and 1 year period, is it due to the sharp rally seen in the last 2-3 years, or leading to not getting value in the market?
Yeah, so I think sterling value, if I'm not mistaken, I think has beaten the benchmark.
Yes, it has beaten the benchmark.
Yeah.
But in terms of what it was ranking 7-10 years ago, the ranking has slipped.
Yeah, so I think the 5 year ranking is still very good, but notwithstanding, I think the logic is the same. This is another fund where we have reduced our exposure to SMIDs over the last 18 months. So we used to be as high as 50% maybe 2 years ago. Today we are at about 30 odd percent. And again, we've tried to rotate out of high beta sector. So I think we are planning really for the next cycle. And when you're managing large money, I think it takes time to move in that direction. You can typically sell SMIDs when the going is good. You can't typically sell SMIDs when the going is not good, and everybody else wants to sell. So when the going has been good over the last 12 months, we've actually tried to reduce our exposure. And we are hoping that over the next 2 to 3 years, we will be able to rotate back into SMIDs at some point of time when valuations are much more attractive. So like I said, we're very, very contrarian to what the market is thinking. And we are hoping that if we get the contrarian cycles right, we should be able to generate long-term alpha. And I think the real goal is that to generate longer-term alpha rather than worry about 1 or 2 year returns.
At what level do you think the market will seem attractive? Are there any metrics or standard you use to see whether the market overall or maybe a sector is attractive or not?
So if you ask me, I'd want markets to be as cheap as they can be. So I would love it to be at 16 times, but that would mean all hell breaks loose from where we are today. But that's just on a lighter note. But I think respecting long-term averages is a good starting point. And like I mentioned, anywhere between 17 to 18 times 1 year forward Nifty is, I think, a very attractive level for investors to actually get in, assuming that bond yields stay where they are, right? If bond yields were to fall very sharply, then I think calculations would automatically change based on other metrics that we also use. So P is just one metric. So there are the earnings yield, bond yield calculation, not only with Indian bonds, but also with US bonds. I think that's really the global cost of capital barometer. We also look at, several other data points like market cap to GDP, try and see, where we are in terms of historical averages or percentages. We like to look at, really, we look at a variety of ratios. I've just named 3, but there are a variety of relative ratios that we look at when it comes to sectors, when it comes to mid caps to large caps, mid caps to small caps, etc. So it's a combination of all these, and with my opening comment, I think that's really what I said, where I think we are in for a grind this year. To our mind, unless there is very, very clear visibility on GDP growth accelerating and on earnings upgrade cycles starting once again, I think it is going to be a tough market, at least for the next 1 to 2 quarters. So I think it's a good time to wait and watch. It's a good time to think about our portfolio allocations. It's a good time to think of asset allocations as individuals and see whether we need to do some amount of reallocation, recalibrate our risk reward framework, and in that light, look at the next 3 to 5 years from an investing perspective.
Daylynn, anything to add on the sector? How do you select sectoral calls based on the value? You spoke about the 1 year forward P, but any particular threshold to look at the sectoral things?
No, I think different sectors have different nuances, so we've got to respect, those what we call as KRAs for each and every sector. For banking, it's different. For pharma, it's different. For IT, it's different. For capital goods, it's different. So I think that really boils down from what our macro view is and which sectors we think could potentially benefit from that macro view. It's also about, like I mentioned, where valuations are attractive and whether we believe the market is grossly mispricing or undervaluing a certain set of sectors or stocks. So I think it's a combination of many things. There's not a single pinpointed answer that I would like to give on that.
Daylynn, another thing is there any segment in the markets, in your opinion, that is currently seemingly dissipatively undervalued?
No, not really. I think the very common answer given today is financials look very undervalued, and that's because of history. But I think there are also reasons why one could argue, this is the new normal for them as well. But I think, like I said, I think there are more bottom-up opportunities where I do believe valuations are getting attractive at a stock level. But I think from a top-down perspective, we still have some room to go. Valuations are not attractive at all in SMIDs. I think they're yet to reach, threshold levels where one would, should really start to worry that I might miss out on a big rally if those valuations come. And even on large caps, I think maybe select pockets there are some value, but there are a lot of areas where there is a lot of overvaluation as well. So I think going back again to my comment, I think we are in a grind phase. There is no real absolute value on the table today across, and therefore one needs to be a little careful about how you're allocating your capital, you're constructing your portfolio, and what risk reward kind of equation you are willing to work with.
But in large cap, where do you look at the value? If you're looking some things, there is some value in the large cap. Which are the pockets there?
So I think clearly, I think select private sector banks stand out as far as value is concerned. I think there is some amount of value in metals. I think that's another area where we believe that at least valuations and cash flows are still pretty strong. I mean, risk reward is neutral in some sense. Um, Most of the other sectors, we are still finding difficulty in seeing large absolute upsides. When you think about where long-term valuations of those sectors have been, or where profitability of those sectors are, growth prospects of those sectors are. So I think that's really where at least we are seeing some amount of value.
Okay, now, how do you define value investing? What makes a stock a value stock? Are there any set of characteristics that you would like them to have?
So again, I mean, it goes back to what I said. I think there is no one formula to figure out what are the characteristics that are required. I think very simple, basic hygiene factors. We worry a lot about terminal value of companies. I think that's very important so that you avoid a value trap. We also worry about uh, uh, the kind of earnings forecasts that are built into companies. We've typically seen that a lot of earnings, I think, of sectors are much more cyclical than investors believe them to be. And therefore, there can be very, very strong negative surprises when reality turns out to be different from what we have forecasted. So I think these are two areas that we need to be very, very careful about when we think about value investing. So something may necessarily look cheap based on forward projections, but in reality, they're not as attractive as you thought they were once the numbers actually come out, right? So I think these are two areas where we pay a lot of attention to and we worry a lot about. Uh, the third area, obviously, is on governance and liquidity. I think these are both very underappreciated in a bull market. But in a bear market, we will really see true colors coming out, where people and more investors will start to focus on not only governance but liquidity as well. So I think these are the three areas we need to be today most watchful of, given the current market environment as such. Value investing is just a simple concept. It's just about uh, being contrary and not falling for the best story that is being told to you at this time, and holding your nerve not to chase sectors or stocks that are very, very hot, without doing a very thorough analysis of what the long term value creation can actually be from those companies. And while you may lose out on one or two opportunities, I do believe from a larger scale perspective, when you buy 50 or 60 stocks, losing out on one or two is fine, provided you've at least got a larger portion of your calls right, right? So I think FOMO is really the worst thing you could do as a value investor, and that is something that we uh, try a lot to avoid. It's not that we don't get in, we don't get sucked into it, but it is something that we spend a lot of time trying to avoid. And really, that's easier said than done, I would say, especially in a bull market.
Dylan, you rightly mentioned, but uh, can you just elaborate what are the most common value traps that investors usually fall into, and how do you identify the value traps?
So I think first is I think the biggest value trap is just to say, oh, something trades at 5p or 6p and therefore it's very cheap and you should buy it. I think that's a very simplistic definition of what value investing is. I don't think it's as simple as that. I think that's the first value trap we all fall in. There are many reasons why companies are cheap. It could be governance, it could be long-term growth potential, it could be terminal value destruction. It could be a whole host of factors. It could be balance sheet leverage. It could be a whole host of factors. So I think that's the most common value trap that most of us fall in. Uh, and the second area is that where value traps typically occur is, like I said, when forward estimates are not very closely paid attention to, and more importantly, when macros change, things change quite drastically for a variety of sectors and stocks, and not paying attention to some of that can also be very, very value destructive. So, I think it's a combination of all these things where investors need to pay much more attention on to try and avoid value traps.
So, how do you value a stock? Do you have any strict rules when it comes to valuation?
No, it's a combination of factors. There's again no one formula works, but I think we try and pay a lot of attention to simple financial ratios. We look at historic price to books, we look at EV to sales, we look at EV to operating cash flow. So we look at a combination of factors to try and figure out where we are. But most important, and we spend most of our time trying to figure out where are we in the business cycle of that particular sector or stock. Because I think that is very, very important. And I think that is really something that we try and figure out. Can we get the timing right in terms of either entry or exit into a particular business cycle to generate alpha? So it's a combination of, like I said, scientific ratios, but also the intuitiveness or the art of trying to figure out where are we in the business cycle, where are we in the valuation cycle of many of these sectors and stocks.
So, Dylan, do you think that stocks which seems like a value trap today now can become a value at a certain point going forward? Are there any exceptions in such cases?
No, there are always exceptions in the investing world. So I think that is something that you have to take note of. Difficult to say if something is a value trap today and can become a value buy tomorrow. I think as you screen stocks, as you screen sectors, you will come across such opportunities as such. But I think that's all part and parcel of the investing world. You will get a few wrong. You will fall into a few value traps. That's all part and parcel of the journey. I think what's critical is to try and limit those value traps in your portfolio to the minimum, right? Or so that you don't try and harm alpha generation. I think that's really what's most important at this point of time.
Well, that brings us to the last question. What are some basic portfolio construction and allocation strategies that a new investor should keep in mind?
I think uh, I'm not a guru on investment advice. Let's be very clear. But since you've asked me a question and there's a gun to my head, uh, I would only say that I think very carefully about what your return expectations are, of what your long-term goals are. Don't get carried away by short-term time periods of either extreme bullishness or extreme bearishness. So plan for the future in a much more measured, realistic way, in some sense. Try and be as diversified as you can. Running concentration is great when you get it right, but it also hurts very badly when you get it wrong. So be careful. And I think most importantly, try and respect asset allocation. So if you're someone at a particular age where you need to take lesser risk, do take lesser risk. If you're at an age where you can afford to take more risk and risk more capital, do take it. So be careful about how you think about asset allocation. Pay attention to it. I think it's a very important learning that I think every person, every individual must spend time thinking about. I think we all spend much lesser time thinking about that, and we should spend more time thinking about it. That'll help us have better outcomes and maybe be happier in terms of our long-term financial goal, achieving our long-term financial goals.
Well, that's a wrap. Thank you so much, Dylan, for doing this interview with us. Thank you so much.
Thank you for having me. Thank you very much.